given that backdrop, you would also, it's interesting you would say that bank lending is back at GFC levels, or sorry, recession-like levels. So if we extrapolate what you just said, which is further rate cuts to come, another 100 basis points next year, does that then give me a kicker from renewed bank lending? Does that come from the small business community, which has been the most sort of, I suppose, repressed through this flying high, equity markets? Equity markets look as if they're on fire, but you've had a real recession in small businesses.
Right. I mean, so far we've had what I call the income-driven expansion, where households are earning wages and spending it, but they're not borrowing. Nothing like what we saw in the pre-GFC period or in the 90s when businesses were borrowing a lot to do investment related to the tech sector. And so the reason why that is because rates were elevated enough that it didn't make necessarily sense for them to borrow. But as rates come down, what we're likely to see, particularly, is a shortening of the duration of borrowing, more floating borrowing. The rise again of the floater mortgage. It's coming back, and as a result, households and businesses are going to be able to use that credit in order to fuel further investment and keep this expansion going.
Okay, well, long live the expansion, long live the records. Bob, good to see you this morning. That's my guest this morning, Bob Elliott of Unlimited.